Hello everyone, this is Mark with Semantics Research with your daily report. So today we had a massive overnight sell, which was quite impressive as the market makers brought the market down, and the treasuries began pulling back across the board today, with the VIX climbing higher, the dollar pulling back, and the gold catching a bid. The ES and the NQ had a large gap down in the overnight session, with the markets closing significantly lower as we made recent lows today. So it seems like the markets are pricing in a recession, with all assets signaling this, and it seems like the market is coming to terms with this finally. And the treasuries are actually, it did pull back a bit, but the front end of the curve remains elevated, suggesting that the near term is still a bit uncertain. And I think the market is coming to a realization that we will have an aggressive Fed. We will likely see a recession. We do have OPEX tomorrow, quite a massive OPEX tomorrow, with about $3.4 trillion worth of options, which is mostly made up of puts expiring. So it will be quite interesting to see how we react in the markets to this as people reposition next week. And yeah, it seems like the energy sector is on sale, with many oil companies on discount after the 75 basis rate hike and strategic reserves being released today. And if we look at the short-term TIPS yields, such as the 5-year and the 7-year, we did go up significantly as traders are either pricing in lower short-term inflation expectations or that the treasury yields are too high at the current moment. The economic situation continues to deteriorate as mortgage rates are above 6%, U.S. consumer debt reaching $16 trillion, and housing affordability is at an all-time low. As rates go higher, it does not bode well with the consumer being saddled with debt, as they are taking on more debt in response to worsening economic situation and high inflation that is eating into savings. High home prices as a result of the huge rise in over the past 2 years and the rise in financing costs is driving housing to much less affordable levels. Although demand is dropping off since home builders are building less, it is likely to make the housing market tight for the time being in the near term. So we will probably see a lag in prices, and it will keep housing prices elevated in the near term before we have a drop-off. Taking a look at the Philly Fed Business Outlook, we are seeing the first contraction in the Philly manufacturing for the first time since the COVID lockdowns. New orders fell 12.4%, and unfilled orders fell 7%, both dropping significantly. Now, if you take a look at initial claims, we had 229,000 number, with a decrease of 3,000 from the previous week's revised level. We are seeing an increase in initial claims in recent weeks, so we are seeing this tick up a bit on average. Now, we are seeing layoffs in the real estate market, such as companies like Redfin. In the face of lower home builder sentiment and higher mortgage rates, we are seeing a plunge in housing starts, which dropped 14.4% month over month, and permits 7%. With a rising rates environment, one could expect demand to go down and probably see the permits number get worse, as it is forward-looking. According to the IEA, we are expected to see oil demand accelerate next year, with global demand averaging 101.6 million barrels per day, exceeding COVID levels. We aren't seeing that much demand destruction yet, with higher prices and with China potentially opening up. That could drive higher demand. global supply will likely struggle to keep up with demand as tighter sanctions force Russia to shut down more facilities, and other producers in the world deal with capacity constraints. OPEC supply can drop due to the Russia sanctions going into full effect later this year. And if you take a look at the products market, we are expected to remain tight, especially in the diesel and kerosene products. The OECD industry stocks of middle distillates are down 25% since 2021, and they're at the lowest levels since 2004. This is driving middle distillates to record highs with a knock-on effect to other products, which is causing pain for the consumer at the gas stations as pent-up demand is unleashed during the peak driving season during summer. Also, the state-controlled Russia energy giant Gazprom said flows to Europe were restricted after Canadian sanctions over the war in Ukraine prevented German partner Siemens Energy from delivering a gas turbine that powers a compressor station on a pipeline that was recently overhauled, and Russian natural gas to Europe dropped and are expected to decline by 40% this year. So you can imagine this will continue to have strains on energy supply. There will be LNG import disruptions from the U.S. Freeport as well, and supply outlook in the EU looks really bad as winter approaches. And as a result, gas prices will likely be driven up during the winter due to the cooling weather. The Swiss National Bank raising rates by half a point is a reminder that inflation remains high and the central banks are behind the inflation curve and they are chasing it. The fact that the Swiss National Bank is getting ahead of the ECB with their rate hikes is signaling that we may be in for a new systemic change, and the Swiss National Bank, which typically fights a strong currency, so the fact that they are doing this is hinting at this regime change. It appears that the Swiss National Bank is thinking that the ECB is perhaps too slow, and as the ECB is dealing with Italian spreads and worrying about fragmentation. So in this climate, nobody really wants to have a weak currency, and it appears that we are moving out of this regime of artificial massive liquidity injections and zero interest rates, and likely as a result, we will probably see many zombie companies being wiped out, and reckless, risky investing into sectors that don't make any sense will likely go out of favor. And that is it for the report. I want to thank you all for watching. Be sure to check out the link in the descriptions for more updates on our channel.